Hey traders, welcome to Charts and Coffee. Happy Friday PCE morning. All right, so for those of you that may not know and maybe don't watch the pre-market in the futures, today we had the PCE, which is, I'm going to show you right here, which is an economic event, something I call a hot zone, that is going to tell us about the way in which the Federal Reserve cares about inflation, right? You might say, well, what about that CPI? That's not even something they really pay all that much attention to. They're looking at the PCE. Now, these two reports have a very different calculation, and the models within the Federal Reserve use the PCE. Here it is, core PCE price index. What the heck is it? Well, it comes out of the Bureau of Economic Analysis. I know there's such a thing. And what this is, and you can see here, for those of you wondering, how does it differ from the CPI? Number one, as soon as the word core is in front of any release, it could be retail sales, whatever, that means they're removing certain things, right? They're excluding what they believe to be high volatility parts of the calculation. So usually it's going to be things that nobody needs, like food and energy, right? Again, going into the ludicrous notion of this data being what we have to watch, and yet that's what it is. The CPI is generally released about a week and a half before the PCE, but again, they're weighted and calculated very, very differently. Just like we have the Consumer Price Index, CPI, this is the personal consumption expenditure. So more syllables mean more important, right? But that's where we are. So you'll see it came in flat, but slightly higher. So you might say, Rob, there wasn't much of a reaction to this at 8:30. Well, remember, we already heard from Jerome Powell, so we kind of have a set expectation of where monetary policy is heading. And if we expected 0.2 and we got 0.2 and we were already calibrated to it being a tenth higher than the previous, where's the shock, right? Where's the shock? So let's take a look at where this really lands. Why do we care? I'm not trading 0.1 versus 0.2, 0.2 versus, we're not trading that. What we are curious about is how this lands. Are there any higher expectations for a rate cut in March? Not meaningfully. Anything above 80% is pretty much fully discounted. And so March is a non-event. What about May? May was probably on and off throughout the week, kind of a coin flip meeting where we might see a cut, we might see a hold, and it's, kind of 40 versus 50, kind of back and forth. This is still leaning, although not certainly done. This is May, but it's leaning towards another hold. That means the rate cut conversation, which, by the way, gang, we are still very much having a rate cut conversation. That means we're going to likely see the quarter point cut in June. Think of how many PCEs, CPIs, and non-farm payrolls, not to mention JOLTS data, and whatever else is unforeseen. I'm only talking about scheduled high impact events or hot zones. What about all those unscheduled events, right? But between now and June, we're expecting to see a rate cut. July firmly shows we're at least one, if not two rate cuts into the cycle. And then by the time we get out to the end of the year, it's most probable that we'll get 2 quarter point cuts between now and December 10. Again, I know it's January 31, which brings us to the next thing. Did the market get PCE'd this morning? It did not. It's holding pretty darn steady. This is the end of the month, which is not anywhere near as important as the end of the quarter, but it is important to keep an eye on what's been a relative outperformer this month versus not. We know the DeepSeek definitely, went for the knee, Cobra Kai style. And there you go. Semiconductors and technology got taken, right? Swept. Now, if you think about the way in which profit taking leads to, now remember, if you're long semiconductors, if you're long XLK, closing and even on the DeepSeek news for a lot of positions would have been maybe not the profit-taking event that they wanted, but it still could have been a profit-taking event. Now, where is the flow going, right? So if I take a look at that downturn, I start looking at what's happened this week, what's continued to maintain strength? Consumer discretionary, not energy, by the way. Communications, industrials have done okay. Regional banks and healthcare and financials have probably been some of the best beneficiaries of that weakness because money doesn't go into the mattress. They're not taking that money out of semiconductors and technology and putting it in a piggy bank somewhere, right? We could say they're going into dollar. Sure, it could be going into bonds or notes. But if you take a look at the sectors, take a peek at that top three: financials, healthcare, regional banks. Now, this is what we do in the Sector Secrets Mastery. And by the way, and I should have this link here handy. If you haven't already registered, this is coming up, gang, in just three trading days. On Wednesday, there we go. On Wednesday, the 5th, we have a webinar coming up, and that's going to be the webinar where I'm going to talk about the last, not just 2 months, 3 months. We're going to have a trades vids of the last 18 months. I'm going to show you some of the tools, the techniques that are staples in my trading, right? We're not reinventing anything for 2025, but we are going to remember that, the shot dictates the club that we're pulling out of. I'm going to pull out slightly different clubs for this year. Am I reinventing anything? No, it's a different gear that, while buy the dip worked great in January of 2024, it's a slightly nuanced and different January here in 2025. And we adapt. We use the same tools in a consistent manner, hence simplertrading.com/consistency. But I'm going to let you in on, okay, these are the adjustments we're making, and these are the kind of trades we're looking for. All right, so something you can think about between now and Wednesday is financials, healthcare, regional banks, benefiting the S&P and Dow, benefiting the S&P and Dow, benefiting the Russell, right? Think about how those sectors weight within the different indices. And those are going to be huge, huge, huge lessons that as you go through your trading career, you're going to be able to differentiate between, why aren't all the symbols moving in the same way? Because they're not made up in the same way. They're not comprised of the same types of sectors and weightings and stocks. All right. So as always, if you have any questions, feel free to type them in. And, ultimately let me show you what the intraday looks like. Because if you're ever wondering, how does the reaction to something like this, when something is so flat, here's your 8:30 candle. We would hardly know anything happened. So whatever was discounted, whatever the behavior was yesterday, which was largely, as you can see here, we had a pretty good idea of how traders were positioned at the close yesterday by looking at the candle here from the 30th. It's a pretty up day, probably not a lot of reason to do much. We've already moved higher. I think that's another thing that oftentimes we forget. This is not about the 9:30 bell. Oh my gosh, there's so much that's been going on since 8 p.m. yesterday. And partly you can see here, we've already moved up from 61.05 to where we are now here at 61.21. This is before the bell even rings. Remember, this is a 23-hour market. The futures are moving and grooving long before and long after the cash session, right? That 9:30 to 4. All right. So moving on then to, and again, if you haven't already registered, I'll put it on the screen there, simplertrading.com/consistency. All right. First question up is GR asks, for day trading, do I prefer to enter with 0 days to expiration or with micro futures? Also, day trading, do I prefer to look for long entries? All right. What are we going to trade if we're trading the S&P? So let's just use the S&P, for example. Since you brought up 0 DTE, there's the ES futures, there's the SPY, there's the MES, there's the SPX. So we've got the S&P futures mini contract, S&P futures micro contract, the ETF of the S&P futures, and the SPX, right? So that's 4 ways right there. And I haven't even gotten into the options on the futures, right? So there's lots of ways to trade the S&P. What I have taught, right, for years, and what I will recommend, and I think a lot of traders are learning from this, so it's good that people are realizing that there's one symbol to look at, right? S&P futures. Why? Why would I look at the ES for everything? Because this has been trading for 23 hours. So unlike the SPY and the SPX, which have to take a little nap, right, between 4 p.m. and 9:30, this ES is moving and grooving. It's accounting for the things that will have to be discounted and reacted to, usually with gaps right at the bell. You can see here since 8 p.m., the S&P has been slowly, not inspired, but it's been moving higher, right? So I'm already getting, and this is why I teach my traders to use the ES. And again, this is where you want to be at. You don't want to look at the SPX. I'm not charting the SPX or SPX options or whatever else goes on out there. Look at the market that's giving you a complete view of the S&P. Forget whether it's an ETF or futures or mini or micro. This is where we want to start. If ES futures give me a setup, then all those other choices that are high concentration weighted S&P symbols are going to follow it. SPY, SPX, MES, right? So this allows me to look at one thing and one thing only. Now, once that's out of the way, then GR, do I want to focus on 0 DTE? Gang, that's just such a trendy thing right now, right? Like parachute pants, mohawks, and mullets. I want to look at what's classic. And what's classic, GR, is what do you want to trade? Do you want to be a futures trader? Great. Beautiful leverage product. Do you want to trade SPY because you don't need to be in a symbol that's going to have the kind of depreciation later in the day because of 0 days to options? SPX is far more volatile than SPY, right? SPY is far less volatile than ES futures or MES. So it depends on the leverage that you want to manage, right? Everyone's wondering which is going to make me the most money. Wrong question. I know that's not what you asked, but in the back of everyone's head, the reason they're flocking to the SPX, rather cluelessly, by the way, is because they're asking what's going to make me the most money, right? On the flip side of that is what's going to lose you the most money, highly leveraged products. While there are great opportunities in ES futures, there's a lot of leverage there, right? MES might be a better place to start. While there's a lot of leverage, even in the SPY, SPX is far higher. SPY might be a better place to start. So start with the place that you can start to get your S&P trading chops without paying a big price for the learning curve of anything like this. That's always the main goal. So it's not what's the best one. That's what everybody wants to know, right? What's the best one? The one that you want to focus on for setups is the ES futures, and then how you trade the ES futures, completely up to you. Do I like the long side was the last question. Yeah, I tend to think the psychology around the long side of anything tends to be the easier psychology, absolutely, to take advantage of. All right. Hey, Jay, looking forward to the webinar. So am I. The Trish Boss and I have been hard at work on, the charts and a lot of the things that we're going to cover. A lot of folks have been asking Rod, kind of to GR's question, what expiration do you like to use? What style would affect that? We're going to get into things like that too. So I'm really looking forward to that conversation. How important is risk management? How important is understanding position size? Does this work on long-term setups? Does this work for day trading? Does this work for swing trading, right? We're going to talk about a lot of things because it's not just about right now, but it's about how can you learn things that'll work for January 2026 and 27. How can you learn tools that allow you to trade any kind of environment? Because this is a markedly different environment than last year. All right, next up is Zeke. Oh my gosh, Meb says, who remembers Zeke Cavarici pants? Oh gosh, yeah. I didn't have Zeke Cavarici pants. I did wear Capizios though. That was a big thing. White Capizios. Yeah, that was a thing too. All right. Moving on. When I say it's just too early to trust healthcare yet, it's been heading down since August. It seems to be breaking that trend recently. So again, it kind of goes back to definitely one of the conversations we're going to have in the webinar on Wednesday. Now let's take a look at, in fact, one of the things that Trish Boss asked me to do here. Okay, for this webinar is, hey, let's get a little bit into index sector stock, another thing that I teach. Let's talk about the broader average, the implications of weighting like we talked about with the relative performance, and then ultimately why that sector, why that stock. So if I'm looking at healthcare, Dow ideally and or S&P should be up, top of the food chain. Next would be healthcare. And if I look at healthcare, is everything equal? Oh gosh, no, right? The most bullish symbols here: Amgen, Thermo, ISRG, Abbott, BSX. Things that aren't not quite ready for prime time, but probably heading generally in the upward direction, although not in as good a way, would be things like Lilly, UNH, and Johnson & Johnson. They're almost there, right? What do I want to avoid? Anything 24 to 48 hours in front of earnings. Case in point, why we never, in the Sector Secrets Mastery, I'm never going to put capital in harm's way just because there's the thrill of victory and the agony of defeat. Look at Danaher, great looking stock. One reason and one reason only to say, you know what? I'll come back after the mosh pit. Take a look at earnings. Can you imagine some poor soul bought Danaher up at 258? That's a tough morning. Why? Because they ignored the economic events that could sharply and frankly quite dramatically, for usually no reason at all, earnings have become, as I like to say, a spectacle. But this is why we avoid earnings. Does anyone want to make a binary bet on that? I care for my money and I care for my nice gradual P&L way too much to make, lottery scratch off ticket bets like whether or not Danaher is going to keep going up or down on earnings, because the ramp up into earnings was beautiful. Look at that green candle, higher highs, higher lows. Wouldn't we rather trade that nice climb from 236 to call it 258? Or do we want to guess at where we go from 258 on earnings, right? Hey, some folks might say, Rock, I want to guess. And that's totally cool. That's what makes the market and the world go around, different strokes. But I will always take the tact of how much could I lose, not how much could I win. And it's really funny when you take that tact, and you'll see this when I share the big longer term P&L and also what we did last year. Bottom line is your account grows when you focus on the things that could hurt your account, right? And if I'm driving around a track and I don't know where the potholes are, I might have a great car, I might be flying, but the one pothole and that's it. I've got a flat, and that's it. And that's where I think a lot of traders are optimizing getting around the track really fast. They're not looking at the things that could completely destroy the car, right? All right, so that's something that we continue to watch. Yeah, Netflix is a pretty good stock, Donald. It's a pretty good looking stock in the communications sector. In fact, that's probably one of the top 3, top 4 weighted, and top 3, top 4 names that I'll be keeping an eye on, along with Meta and Google. In fact, yesterday, one of the things that I was walking traders through was as price sunk down into the daily price movement range, really below 972, really below 971.80, that was where you would look for an at or slightly in the money call. And so that's how we position ourselves in situations like this, where it's a down day and it's never going to be on good news. And why a buy the dipper like that has a better risk reward ratio. And actually this morning, you've got some choices as far as whether or not you'd maybe like to take a slight amount of profit. I wouldn't really look for anything too closer than 980 for a first target. But this is a setup we talked about quite a bit in the room when we're doing the swing trading session, which we do between 10:30 and 11:30 every day. And then the next level, could we hit 1,000? I would probably step out in front of size around 999 and change. But yes, it's not out of the question based on historical volatility and probabilistic thinking about what a symbol is capable of doing. Yeah, that's definitely Donald, that's definitely in the cards. But where do we get in to take advantage of that, where we can manage risk? And that's where that gray zone sets us up for that move to, say, that $1,000 area. Sure. All right. Next up is GDX. I was building a GDX multi-chart. Cool. I love that folks are building these things. Andy, I love it. GDX is probably an up-and-comer, not maybe quite ready for prime time across the board. The stocks, NST and 2899, don't populate. Yeah, sometimes I just skip them. So when you go through some of these sectors, you're going to realize after the first 4 to 5 names in something like GDX, things can get really wonky. Just skip them. Yeah, you'll see my NST is spinning around. 2899 is not even there. Sometimes there is a different symbol for that. You can just look it up. But yeah, I just skip it usually, Andy. Yeah, how do you build some of these more nuanced niche ETFs where they have some funky names? Yeah, just skip it. All right, gang, that's a wrap. So thank you as always. And I will see you all on Monday, same time, Same station, gang. Be good to each other. Have a great weekend, by the way.